Consumer advocate, tax expert, and educator Ed Slott is here to help you rescue your retirement by following his time-tested method of avoiding the 5 silent retirement killers. The Wall Street Journal called best-selling author Ed Slott the best source of IRA advice, and USA Today said it would be tough to find anyone who knows more about IRAs than CPA Slott.
Thank you. Welcome.
Here's Ed Slott.
Thank you. Thank you. Hi, everyone. I'm Ed Slott, and this program is called Life Insurance for Life and Beyond. Well, first, why am I talking about life insurance? Because life insurance may be the most underused strategy to protect large retirement balances from being decimated at the highest levels of taxation. So who's most at risk? Those of you who have the largest IRAs or other tax-deferred savings accounts. If you have taken the time to watch this DVD, then I know you want to learn more. So before we begin, just so you know, I don't sell life insurance. So why should I care? I don't sell stocks, bonds, funds, insurance, or annuities. I'm a tax advisor, but it's all about the taxes. I also believe most people don't understand how life insurance works as an effective planning tool. I don't sell it, and I'm no expert in exactly how all the various life insurance contracts work. That's why there are life insurance professionals that you need to work with to fill in all the details. But I do know the end result. It's like a car. I know it gets you there, but I don't know how the engine works. But I do know how life insurance can fix lots of money and retirement problems, and even create wealth, and tax-free wealth. And you know, I love tax-free. I only care about the end result, the benefits to you. I want you to know how powerful the end result is. I want to give you enough here so that you'll understand what life insurance tax planning can do for you and your family, both during your lifetime and after your death. So why don't most people take advantage of life insurance? Because every time you hear life insurance, some people just tune out, or you put it off. And most times you hear about life insurance, you're hearing about it from someone who sells it. So maybe you feel like you're being sold rather than being advised. Maybe you think, they're just trying to sell me something. So you think, I'll avoid the meeting or avoid the discussion. And maybe you're right. Maybe you feel that you're just being sold, so you don't see a benefit to you. But I'm here to tell you, you could be wrong. I want you to understand what's in it for you from an unbiased, objective tax benefit point of view. Well, now you're meeting with me. So let me tell you why I believe life insurance is the missing piece in most people's retirement and estate plans. The tax exemption for life insurance is the single biggest benefit in the tax code. I don't even think life insurance professionals use it enough or appreciate it enough. Maybe that's why they don't sell enough of this product. I put this brief guide together for you in the hope that you'll view it and see how tax planning with life insurance provides powerful benefits. And then you'll continue this conversation with your life insurance agent who can fill in all the details. Except that now, when you meet with him or her, you'll have a better understanding of the benefits and what questions to ask. You'll definitely be more involved in the discussion, especially when it comes to your retirement. First, let's see what the problem is, and let's see what the solutions are. The good news is that taxes are generally money problems, and life insurance puts lots of free money, tax-free money in your pocket. So most tax problems can easily be avoided with great planning. Here are both the problems and the solutions, and I want to give you this program on 2 levels: the problems that can affect you during your lifetime, and the problems that can affect your beneficiaries, your family, after your death. So why would you care about a solution if you didn't think you had a problem? Well, if you have taxable savings, you have a problem, and so do your beneficiaries. In my public television program, I tell you about what I call the 5 silent retirement killers, and they must each be addressed, and one of them is risk. Most people think of this as investment risk, as in the stock market. But when it comes to your retirement savings, especially taxable IRAs and 401ks, an even bigger risk is tax risk. Many people think that simply having retirement savings is enough. It's not. It's what you keep that counts after taxes. There's a mortgage on your tax-deferred retirement savings. Most of that is owed right back to the government. In fact, future taxes could be 50 or 60% or more by the time you reach in for yours. That's not real money. The only real money is tax-free money, spendable money, where you keep it all. Plus, with IRAs and 401ks, you have to take required minimum distributions on that money after you reach age 70 and a half years old, and you're forced to pay taxes on the government schedule, not yours. That's the government plan. That's not real money, since it's all subject to tax. Are you wondering what future taxes could do to your retirement security? You should be. You know why? You've caused the problem, especially if you've done everything right. You saved, you sacrificed, and built a healthy retirement account, a 401k or an IRA. So what's the problem with IRAs? The problem is they're tax deferred, not tax free. That money will be taxed at some future point. With an IRA, a SEP IRA, a simple IRA, 401k, 403b, or any other type of tax deferred retirement plan, you received your tax deduction up front. Your retirement funds have grown tax-deferred all these years. So far, so good. You've done well. But there'll be a day of reckoning. You'll owe income tax when you begin to withdraw, just when you need the money the most. How much tax? We don't know. That's the problem. You won't know that until you need the money the most in retirement or after you die when your family inherits. This uncertainty keeps people up at night. So that is the tax risk. But there's another risk, market risk. Your retirement savings and other investments, if invested in the stock market, are also at risk of being lost to more Wall Street fraud or manipulation or a market crash at the wrong time for you. So let's review up to this point. Typical tax-deferred retirement savings like IRAs and 401ks are subject to two major risks, investment risk and tax risk. Now here's where the life insurance comes in. Life insurance can be used to remove both of these risks. Investment risk with life insurance, you get certainty, a guarantee. You cannot get a guarantee in the stock market. And tax risk, you eliminate that by never having to pay tax on this money. So you need to create a plan to move your money from accounts that are forever taxed to accounts that are never taxed. Life insurance is the best provision in the tax code to do that. Wouldn't you sleep better at night if you knew your retirement savings were no longer subject to these risks? But still, the benefits are misunderstood and not used enough in planning. So what are the benefits, and exactly how would you use life insurance in your planning? First, when I talk about life insurance, I'm referring to permanent insurance, permanent life insurance. Even with permanent insurance, there are several options, so you need to speak with an insurance professional for all of those details. And I mean permanent insurance as opposed to term insurance, which is more for younger families looking for the maximum death benefit. So here I'm talking about permanent insurance for those looking for retirement security and estate protection. As I've already told you, you have a tax problem, especially if you have significant funds in taxable and tax-deferred accounts. Your family will also have a problem after you die if no planning is done and they inherit mostly taxable funds. They're going to be dealing with these tax issues too. They also may be dealing with estate taxes, depending on the tax law when you die. And that changes all the time. So you need to plan for the worst-case scenario and hope for the best. Your family will most likely also have a liquidity problem if retirement funds and other assets have to be cashed in quickly in order to raise money after death for taxes and other post-death expenses. Money is often needed after death to resolve all kinds of issues besides taxes. I'm talking about family squabbles, etc., family members wanting money more quickly. The last thing you want is for your family to have a fire sale, especially if there's a family business or other valuable property in your estate. You don't want your family wasting or cashing out retirement accounts or other valuable property prematurely because cash was needed quickly. You need to do a liquidity test right now so you can see if your family will have a cash problem after death. To gauge the problem, what I do is I take clients through my own type of liquidity analysis because most people are not liquid enough to avoid having their families starting to have to sell off investments, cashing in retirement accounts, and triggering unnecessary taxes. So what does my liquidity analysis do? It shows you how much of your estate can be turned into cash quickly without triggering taxes or losing property value. Cash is often needed after death, even if there are no estate taxes. And remember, that's only federal taxes. Don't forget state estate taxes. There are always expenses, and the IRA is the last account you would want to have to tap into to pay those bills. Remember, IRAs are subject to both income taxes and estate taxes, could be subject to estate taxes, which could eat up a lot of cash quickly. You can work with your advisor and your CPA or accountant on this too, this liquidity analysis, to go through it with them. But here's what we do. We have clients make a list of all the assets you own. So do that now. Make a list of all the assets you own, less liability, mortgages, loans, debts, etc. In other words, your net worth. Now you have this list of property. Code all the property as either liquid or non-liquid. By liquid, I mean assets that can be most easily and quickly turned into cash without triggering a tax. What I call money you have to pay a toll on to get it, toll money. You're left with basically cash. Well, here's what I mean. IRAs I wouldn't include as liquid assets. You might say, oh, I have all this money in my IRA, but you have to pay a toll to get it. It's not liquid. You have to trigger taxes to get it. So I wouldn't put IRA in with liquid assets or cash. So here's what we do. We do a percentage, a fraction. The numerator is liquid assets, basically cash, your bank accounts, and I don't mean actual cash, but bank accounts that you could get money easily out of without triggering a tax bill. And again, do not include IRAs or 401ks here. Sure, they can be cashed in, but there's a toll on that money, and that will trigger a tax. Include only assets that could be sold quickly without triggering a tax or other expenses or losing significant value like a fire sale. Sure, you could get money out of it quickly if you sell for a low price. So that's the numerator, basically liquid cash and accounts. Now the denominator is the value of your entire estate, everything, including the cash, including your assets, business interests, real estate, include all property in addition to the IRAs. Now look at that percentage, look at that fraction. For most people, cash over the total estate is about 5%, if that much. Do you know what that means? Turn it around. In other words, this means most estates are 95% illiquid. That's a problem. Unless you actually do have a ton of cash laying around available, but most people don't. Most people, when I do this liquidity analysis, at that moment realize that they have a huge liquidity problem. So now you know you have tax exposure, stock market risk, and a liquidity problem. So how can life insurance help? Two ways. During your lifetime, so there's something in it for you right now, and after your death. During your lifetime, you have the ability to reduce both stock market risk and tax risk by moving your money from accounts that are forever taxed to accounts that are never taxed. You can actually do that two ways, Roth IRAs and life insurance. Both cost money now, but with life insurance, you'll be creating a bigger pot of tax-free money later when it's most needed. It would be great if you could do both and turn your entire estate into a tax-free windfall, both during your life and after death, but the more powerful way is with life insurance. And again, I'm talking about permanent life insurance that has cash value. You can contribute more with life insurance than you can generally to a Roth. With a Roth IRA, though, it's easier to access your money if you need it. Roth IRAs are income tax-free too, but they are a part of your estate and subject to estate taxes. But Roth IRAs provide no additional death benefit, as life insurance does. Life insurance comes with a guaranteed death benefit, and that benefit, unlike a Roth IRA, can be set up to be estate tax-free too. So what can you do to remove both the stock market risk and the tax risk? First, you can leverage your retirement savings like an IRA. If you have a large IRA, it may pay to draw it down now and pay tax on the distributions. Then use those distributions to invest in a permanent life insurance policies. Remember that tax rates are still at an all-time low right now, so now would be the best time to strike. Even if it costs you some tax money, it still pays because you are lowering your tax exposure on your IRA. And anyway, after age 70 and a half, mandatory withdrawals from the IRA must begin, whether you like it or not. Since the money will eventually have to be withdrawn anyway, it may as well be leveraged by using the money to pay the life insurance premiums. You're basically paying off the mortgage on your IRA early, so you never have to worry about tax risk. And the funds invested in your permanent life insurance policy are now growing tax and risk-free. And you can have lifetime access to the cash value tax-free if you need it for retirement. So during your lifetime, you can, in effect, turn your taxable IRA and other taxable savings into a tax-free savings vehicle. It's really just like changing pockets from taxable accounts to tax-free accounts, except that now you've also built in a guaranteed death benefit to benefit your family. It's generally judgment-proof too, the life insurance I'm talking about. If you have other taxable funds, you might want to keep those protected from future taxes too. Many people who are looking for places to shelter money from taxes, stock market, risk, and lawsuits are stuffing taxable money into permanent life insurance as a lifetime personal protected savings account. All the growth is tax-free for life and beyond. So those are the benefits to you during your lifetime. What about post-death benefits for your family? Well, if you don't need to tap into the funds during your lifetime, your beneficiaries are guaranteed a death benefit. The stock market has no such guarantee. Your family will now have guaranteed access to a ton of tax-free cash. Tax-free means they keep every cent. No tax erosion here. They will have tax-free cash to pay estate taxes if needed, to pay expenses, debts, mortgages, all without triggering taxes or having to sell a family business or other valuable real estate or other property that could trigger taxes. If they had to use your IRA to pay these bills, they would first have to pay income taxes and maybe estate taxes too, leaving very little to pay bills or for them. So don't just sit there and admire your IRA like most people do. Leverage it now. Use it, leverage it, or lose it to possible future higher taxes. Never underestimate the value of leveraging IRA money by using it to pay life insurance premiums. The larger the estate, the higher the estate tax. Having enough insurance money available to cover the estimated estate tax will avoid having to invade the IRA to pay the tax. Now, some people might say, but the current estate exemption now is so much higher, so there probably won't be any estate tax. You know what? This has been changing on and off over the years. This is not an option you can plan with. The estate tax exemption has been changing up and down, and you cannot take that kind of risk. Anyway, what's the downside? If there's no estate tax, your beneficiaries will simply inherit more money, and it'll all be tax-free. That's the downside. But okay, let's continue with that scenario. Let's say there is no estate tax. There are still plenty of uses for life insurance, even if there is no estate tax. You could use life insurance to replace stock market losses. I had a doctor client a few years ago that had this account. He had about $3 million in a brokerage account. And he said to me, I want